Good evening, ladies and gentlemen, and thank you for joining us this evening on a very pertinent topic and a very important point in time. Camco Invest is pleased to host a discussion on the economic and financial impact of the next White House administration. It seems that much of the discussion these days revolves around the pandemic that we are all deeply entrenched in globally over the last 7 or more months. We are slowly understanding more and more about its impact on our daily lives, from past mass closures to the threat of new ones. We are seeing firsthand the economic impact as time rolls on. Staggering and historic deceleration in all economic indicators across all global economies is definitely a challenge that is being addressed through an ever-evolving monetary policy across all major central banks. But as we navigate forward to the inevitable and are a fortnight away from the most important exercise in democracy, the US elections, we must take a hard look at the potential outcome of the policies that will help shape the largest economy in the world and what it means for the rest of us. The aim of our discussion is not to place a bet on who will be the victor of the elections on November 3rd, but rather be prepared with expectations on how the next commander-in-chief and his administration are likely to respond to the current economic challenges facing the United States. More importantly, we must consider their impact on financial markets globally, and of course, consequential impact on the GCC. In case of a Trump victory, what will be the Trump effect this time around? Will it support an economic recovery and push financial markets to new heights, as was experienced in late 2016 and through most of his presidency until COVID struck? Or will the Trump effect be the exact opposite? The next obvious question would be, are we to expect a Biden boom in the horizon, or shall we anticipate a Biden bust? On oil, will we see further support for shale producers heavily skewing the global supply picture in the face of waning demand from the pandemic? Or will the new administration curb the impressive ramp-up in supply that was experienced over the last decade through environmental protection measures and moving away from dependence on fossil fuels? On the US dollar, the reserve currency of the world and one we depend on to trade our exports, which candidates' policies will be supportive of a decline versus other currencies and which might have the opposite effect? Not only do we have to look at commodities priced in dollar, but also the servicing of dollar debt that has been accumulated over the previous decade by emerging market economies to fuel their growth. Now, these same economies will need to tap into the dollar debt market to plug the holes in their budgets. Will an active role in fiscal policy be supportive for the dollar as is anticipated from a Democratic win? But then again, a superior earnings dynamics was a key reason for the dollar's strength over the last decade, supported by improving tax treatment by the current administration. Given that the US dollar interest rate advantage has been eroded almost completely this year, and eroding of the advantage of higher earnings would most likely accelerate the trend of a weaker dollar. Trade tensions and geopolitical risk, how each candidate maneuvers around these challenges will have a direct and indirect impact on our economies. We must prepare ourselves by asking how. Today, we are proud and appreciative of the opportunity to discuss this complicated yet interesting subject with our 3 guests. Our first guest is Mr. Jae Yoon. Jae Yoon is the Chief Investment Officer of New York Life Investment Management. He serves as the chair of the Investment Governance Committee, responsible for the oversight of the investment performance of the strategies managed by New York Life Investment Management's boutiques and affiliate portfolio teams. Additionally, Mr. Yoon leads the multi-asset solutions team, which oversees the portfolio management of mainstay and third-party multi-asset strategies, and asset allocation services and economic analysis for New York Life. Our second guest from New York Life Investment Management is Mr. Robert Serenbetz. Robert is a multi-asset portfolio strategist at New York Life Investment Management. He and his team seek to guide investors through the rapidly changing investment environment through capital markets insights, managed funds, customized investment solutions. In addition to cross-asset investment strategy, Robert leads efforts towards sustainable investing, helping investors manage risk and generate resilient long-term returns. And our third and final guest, or shall I say dear colleague, Mr. Lubomir Krispinovich, or Luba as he's better known in our hallways, is a vice president in the Equity and Fixed Income Department. In his current capacity as head of investment advisory at Camco Kuwait, He oversees a team of buy-side analysts, as well as strategic asset allocation, portfolio structuring, and quantitative research related to regional equities and fixed income. Welcome, gentlemen, and thank you for joining us this evening.
Okay, so I'll start. I was going to share about 6 slides here just to get the group going in drawing a picture towards the election, and then we can have our dialogue. So could someone take me to my next slide? This is just path of the economic growth. So what path will the economic recovery take, right? That there's been discussions about all kinds of alphabets on how the path of the recovery will happen. As it's a pandemic, oh, you're going very fast. It's a pandemic healthcare issue, and that's impacting the economy. And so no one really at the end of the day knows how the path of the second wave potentially coming and how the recovery will take shape. So the path of the recovery is the most important thing. And then secondly, the policy behind fighting this possible negative path and keeping Americans, at least in the US economy, but around the world, the government trying to keep their people employed and economy operating as full as possible through the pandemic potential second wave. So these two factors are highly uncertain and will have the highest impact to consumer confidence, business activity, and therefore corporate profit. And our translation of what we think is going to happen will impact how we invest. And so it's a quite fluid situation, but these two factors are important. So as we go to we're already at the next slide. This is a simple chart of historical volatility of 90 days leading into election and post-election. So this election particularly, we've seen higher expectation of volatility coming due to some of the disruptive situation between the two parties. However, it is very reasonable when you look at past elections in accumulation that there's always a volatility leading up to election and it fades after election. This time around, the volatility as priced by the market remains high, elevated weeks into the election, as people perceive that the mail-in vote and such may cause a little bit more disruption post-election in terms of figuring out who actually won. That's not just for the president, but more importantly, the Senate count, right? There's this concept of blue wave, which is definitionally where Democrats not only take the presidency and they already have the House, but the Senate majority is up for grabs. And blue wave by definition means Democrats takes it all, and those count will take some time to figure it out. Okay, so I'm on the next slide. Yeah, I'm on that. Okay, that's it. I'm on that slide. I wanted to highlight very simply, you don't have to actually read the numbers. This is all the historical years, election year. Basically, election year has always been positive for US economy or US stock market. And this year, clearly, despite COVID, has proven to be a positive year. I would have never believed that if you asked me in April. So net, volatility doesn't necessarily translate to poor returns. We've always had volatility leading up to election, but majority of the election years were positive. So don't confuse volatility with negative return. Next slide, please. Here's another
opinion, Jay. In your opinion, do you think, on a very high level and in terms of impact to the market, do you believe that it's going to be a continuation? It will be the Trump effect again? Will we see a Biden boom or a Biden bust? Maybe you can shed a little bit of light on your expectations of the outcome on each or the other as well.
Yeah, my personal view, and I think this is the market view, so it's not out of consensus, is if you get a deep blue wave where Democrats win the presidency and take over Senate with a sufficient lead, then equity markets will net like the massive fiscal will get. Ironically, I think the worst case scenario, the way I see it, is if you get Biden winning, but loses the Senate to the Republicans, then you're going to get into a situation like Obama's second term where Biden's hands will be more tied and a lot of his policy promises won't see light of the day. So I think the worst case is Biden wins and does not win the Senate.
And how likely is that? How likely is that if Biden wins, then he might not
It's very tight. It's very tight. So far, the market believes that blue wave is the base case, but what we are reminded from 2016 is the polls haven't been very accurate.
Exactly.
With that, the margin of lead for presidency is very wide for Biden, so that makes me feel that there's a higher chance for Biden to win. But as far as the entire blue sweep, markets are starting to price in for that, but I'm not so sure that they will win. And by the way, they need to win with sufficient majority because there are some moderate Democrats that may not support all of the fiscal that Biden wants to do. So in order for markets to be super happy, Biden needs to win with a decent amount of majority with the Senate, not just by one vote. Like if it's 51-49, that may allow him to do reasonable fiscal, but won't be allowed to do all the fiscal that he promised. So.
And how will his policies, impact corporate earnings? We're hearing expectations of higher corporate taxes and higher taxes on certain brackets.
Yep. So I had a slide on that, but I'll just answer it now. So with Biden, corporate taxes will go up to 28%, and that's calculated bottom up by some. Okay. So let me just finish this slide. So this slide. This slide basically says under different regimes of combination of how the presidency, Senate, and Congress is split, net, it hasn't made a significant difference one way or the other. So under all cases, it's not, despite whichever party that comes into power in whatever combination between presidency, House, and Senate, the equity market in the U.S. generally has been net positive for very long time. But additionally, they're not as bothered by the combination of presidency. Can you go forward one slide, please? And let me just finish this, and then we can talk about your question. So there's been a lot of promises made, but at the end of the day, leading into an election, these candidates make many promises. However, we need to be wary of all the promises made, and we need to focus on what they can actually do to implement their policy and those factors that will ultimately drive down to the equity market, the various sectors, and most importantly, in the current situation, the growth in corporate earnings. So for investors, the point is very simple. Over months and years, election only matter to the extent that the promises made during election are implemented, and therefore we were already talking about what Biden needs to be able to deliver on all his promises. So real policy change will need to be observed, but we know that despite either presidency, we will get more fiscal, both to help the lower middle class America, as well as to build America's growth, which is infrastructure bill. So we'll get an infrastructure bill and further stimulus under either presidency. However, under Biden and a blue wave that we just talked about, taxes are going to be higher, and federal spending under Biden will be meaningfully higher. And again, with assumption that it is going to be a full blue wave, as well as Biden's probably going to change the healthcare policies. He's going to have more regulation. Democrats tend to be more regulatorily driven, and the trade policy between Trump and Biden differ quite significantly. And next slide, please. This is the slide to your question, where under Biden, this is kind of the bottom-up analysis by a consultant, Cornerstone Macro, on how much the taxes may go up. So we're likely to see, on average, a corporate tax of 28%, and then in the United States, each state has their own tax rate, and that's on average 6%. So you're going right back up to 34% tax to corporations between government and state. And that will put us right back to one of the highest taxing countries in the world. And that technically in itself is quite negative, obviously. However, the market has initially taken a negative view, but have switched that with blue wave, that Biden's overarching fiscal will be dominant over the negative impact of tax. So net equity markets generally for now feel more positive towards a blue wave. Like I said, the negative scenario is he wins the presidency, that's Biden, without controlling the Senate. That would actually be negative because some of these regulatory and tax policy may actually be implemented, and maybe he won't be able to implement all of it to full extent, but he'll get it, get some of these tax changes in, and yet the fiscal may not be as large to overcome the increased tax rate. And last slide, one last slide,
maybe
please.
a quick point on taxes, if I may, Jay.
Yeah.
All these taxes, so this increases in taxes, it's meant to fuel what? So what is it meant to satisfy?
Well, so he's basically going to tax corporations and high net worth, wealthy Americans, obviously, to do his fiscal spending. He's actually sourcing his fiscal spending, the massive fiscal spending, from increase in corporate and personal income tax of individuals, wealthy individuals. So that's the way he's going to mend his deficit gap in the long run.
And maybe a quick question, at least on the outcome of the election. What about a stalemate? What if there was a stalemate in terms of the election? It's a contested election, and how long could that drag on, and how will that affect the markets?
Right, that would be quite disruptive for the market. So there is a outside chance that as you get into mail-in votes, we will get the Supreme Court involved, right? If we get into a legality issue, then it becomes a much more dragged out contested election. I think back in the Bush era, we had a recount in Florida that took about a month. And there was a request to recount Florida and Ohio, and I think they only accepted the recount of Florida. There's different permutations of things that could go wrong. And I do think that probability is low, but it's out there. And that's why the Republicans wanting to pass the Senate hearing on the picking their Supreme Court nominee next week becomes kind of an interesting controversy if you're into that conspiracy on that may actually have an impact to the outcome of the election. We're not looking at that as a main possibility, but it is definitely out there. Robert, do you want to actually add something to it? I invited Robert because he's actually been spending quite a bit of time studying the elections. Robert?
Sure, thanks, Jay. The only thing I'll add, your comments have been great. The only thing I'll add is that the concern around a contested election will probably manifest itself in the makeup of the Senate. There are some very key Senate races that are very tight and will likely come down to being counted after the actual election. There's 2 points that I think we need to make here. The first is that the votes are never fully counted on election day in the United States. It actually takes some time for us to validate and count all the votes. So typically the votes are actually finalized sometime in December. The reason it might be difficult, Jay alluded to the fact that the markets are currently pricing in a blue wave, meaning a Democratic sweep and a strong sweep. And that's because they expect fiscal stimulus. Now, if there's contested Senate elections because not all the votes are counted, the market might start getting concerned that the Biden administration doesn't have all the votes they need in the Senate to pass a major fiscal relief package afterwards, in which case the market could get concerned because, like Jay said from the beginning, it's the fiscal policy and the monetary policy that's driving markets right now and the path of the virus. And so the makeup of the Senate will be really, really important.
Yeah, thank you, Robert. So this is the thesis behind contested election. By the way, if Trump wins the presidency, then by definition, Senate will be his as well. So we'll be status quo, because obviously the voters aren't going to go vote for a Republican president and a Democratic senator. So the fact that if Biden wins, generally Democrats will win more seats in the Senate. But question is, will they win sufficient enough votes to be able to pass a big fiscal? And that's what the market's counting on.
Okay. And maybe as we move from west to east and we tackle other topics in terms of impact from the US elections. So on oil, will it be an environmental initiative that will have the greatest impact on oil and shale drillers? Or will the shale industry receive further support from the next administration? So which way could it go? I think that directly impacts us in terms of oil prices and in light of the supply glut that we have globally.
Sure. First of all, I'm not an oil expert, but obviously we read and study about oil as a macro investor. So I'll say this from a very high level. If you get Trump reelected, obviously Trump is either president will be pro-infrastructure spending. How they spend will be very different when it comes to energy or traditional energy, oil. Trump has shown in his presidency high interest in U.S. fracking activity, U.S. energy independence, and he's very pro-U.S. energy renaissance, as he coined it, right? Or the market coined it. And that will continue under Trump. And also, Trump's been very involved with OPEC or the OPEC leaders. So Trump has shown a lot of interest in this area, and he'll support it. And that could be net neutral to perhaps Middle East, because pro-Trump or pro-energy by Trump goes both ways, right? If you're sitting from vantage point of Middle East, but from U.S., you'll be fracking will continue and even get support. Given he wants to, he actually has even tried to bail out the fracking industry back in March, April. He also did encourage fracking to slow down in its drilling to not disrupt the OPEC's wanting. He helped to negotiate to his best effort a safe path for oil prices, right? He contributed. Whereas in Biden, will take a very different policy. He's going to be pro-climate change. He's talked about $2 trillion fiscal over multiple years towards climate change and green initiative. He has not said anything that will directly impact fracking in the U.S. other than he did allude to possible regulation to ban fracking in government properties, which means the amount of fracking that might happen will be reduced. Additionally, the green infrastructure or climate change infrastructure of $2 trillion will obviously over a long period of time go against the frackers in the United States, but also just generally towards energy dependence here in the US. I'll say one thing. Despite if Biden wins and he puts that policy in motion, that will speed up America's obviously move towards alternative. But I look at energy as similar to, if you paid attention to how America splits over something as simple as wearing a mask, right? Americans are about, independence, my rights, and something that to me was pretty simple, like wearing a mask to help prevent COVID. A lot of America split right down the middle on whether it violates their personal rights. I think they will have the same split on climate change and energy. There are certain states that are driven by energy and are not probably going to take climate change as seriously. So the change towards climate change, embracing climate change by by the average American will probably split, and it will take longer for America to get there than Europe seems to have come together on need to move towards effort towards climate change and going green. So it will take a longer time. So I think energy, traditional energy sources in America will stay here longer, but perhaps smaller under Biden.
And maybe I could turn the mic over to you, Luba, right now, garnering the information that was shared just now, and in terms of expectations. So we see that a Biden administration will be supportive for oil prices on the back of reducing supply, and a continuation of the current administration will probably have the similar impact to what we have now in terms of oil prices. How do you believe the effects will be felt here in terms of GCC markets?
Well, I think definitely the impact is there to be seen. However, the overall oil market has been far from balanced dating back to 2014. And we're actually still having significant inventories across the globe. So despite some inventory draws over the last couple of years, the total US distillates are, I think last I checked, around 6 or 7 standard deviations out from their pre-2014 levels. So the inventories have actually continued to rise and stayed elevated. And so the question is really, are those inventories, are we in a new sort of normal of kind of higher inventory levels than before? So I think from a Biden victory side and the green initiatives, I think as Jay already alluded to, it's going to take the US a really long time to kind of really make that shift. Whereas we're seeing that shift more meaningfully implemented in Europe. And actually you have some of the oil majors like Total who are committing to really reducing their carbon footprint, right? So from a supply side, I think at current price levels in the mid 40s, it's balancing the market at this point in time. Is there upside potentially on some supply side disruptions? But I think overall, the demand side of the equation has been significantly shifted over the last 5 years to a decade. And the market has changed in a fundamental way. And I think it will continue to change going forward. And we're seeing that across the globe. Obviously, the major clients for Middle East oil are Asia-based. And so historically, that's been kind of the growth engine for the global economy. So yeah, here in the slide, you'll see that Asia imports around just under 60% of their oil from the Middle East. Obviously, the bulk of that is China. While Middle East oil is not the main contributor to them, they import about 40% of their oil from China, from Middle East. Now, what's happened in China is that over the last 5 years or so, they've really shifted their economy more towards or their economy has matured. And they've shifted more towards a service-oriented kind of industry, whereas traditionally it was more manufacturing-based. Yes, it's still kind of the manufacturing hub for the world, and a lot of goods still come from China. But as a percentage of GDP, it now makes up significantly less of their GDP than before. So their energy requirements are also shifting. And as the economy shifts more towards a service-oriented kind of focus, they're going to require less energy, right? So there will still be a need for oil in terms of some of the derivative products that cannot really be easily replaced. But I think from an energy, pure energy perspective, it's really on the decline. So this is really where I think you have a lot of discussion on kind of peak oil, whether as a major energy contributor globally, it's peaked. I'm not ready to kind of commit to that yet, but I think there are significant signs that point in that direction. On the other hand, Qatar, which is the largest LNG exporter globally, there is a bit of a shift towards LNG because it is relatively cleaner, particularly on the shipping side. Obviously, the main challenge on LNG is the transportation, but there is a significant shift in terms of gas over oil, and so Qatar seems to be better positioned than the rest of the Gulf, purely from an oil versus LNG perspective.
Now, Robert, do you want to give some insight through the lens of ESG on this?
Sure. Thanks for bringing us in. I think Lubo's comments have been spot on in terms of demand, and I also think that Jay's comments regarding this the change in policies from a Biden administration versus a Trump administration have also been spot on. I think what's been interesting is to just see the investor demand for ESG type solutions ramp up as a result of the COVID-19 crisis. They've realized the type of vulnerabilities in business models that aren't flexible or sustainable into the future. And so we've seen so many inflows into ESG integrated strategies or ESG thematic strategies. I don't think that opportunity is over. If you're just thinking about the pure math of flows, that's not a trend you want to be on the wrong side of. I could go through and share a ton of examples about companies that have been on the wrong side of the ESG debate and have failed because of that. But I think just from an investor perspective, you want to be on the right side of flows, and that's what we're seeing right now.
Maybe I can touch. Yeah.
If I may add, to Robert's point and Lubo's point, which is the oil demand growth in developing countries been fairly flat, even pre-COVID, and obviously COVID is dictating a lot near term, but COVID will pass hopefully soon enough or be minimized, and demand will pick up. Having said that, my curiosity is, I wouldn't be as focused on America as I'd be focused on China. China, as the consumer market develops and demand is expected to pick up, has also spent quite a bit of energy and effort, and their very autocratic government, once government dictates, people do, where they've embraced climate change initiative and moving to alternative energy with a lot more force. So as Lubo said, much of the demand in oil has been traditionally emerging countries. Countries like India is probably going to be locked up in the traditional infrastructure and will be oil dependent for a lot longer, but I'd watch the force behind China. And fracking may not be your kind of competitor in the future, as American dollars, as Robert alluded to, the investment dollars are drying up in likes of MLPs and heading towards ESG. So American frackers may not be your kind of competitor, but it's the speed by which countries like China embrace alternative energy and actually can implement it. Implementation is going to take a lot of effort and is imperfect science at the moment.
And since we're on the topic of the energy sector, maybe we could look at other sectors. Jay, could you probably shed some light on which sectors would benefit or which sectors would fare worst under a new administration or the continuation of the current administration?
Right. Well, so far we know that the technology sector, because we're going through fourth industrial revolution as a concept, benefiting for the fact that what COVID did was there's a concept of S-curve of change, where change happens very gradually because people do not want to embrace change, but there comes a turning point when enough mass embrace that change and everybody follows. COVID has exponentially expedited that change. So all of a sudden, overnight, or over a 6-month period, we've had what would have taken another 3 to 6 years to embrace change and embracing technology happen overnight. So here we are on a Zoom session where, probably we wouldn't have done, most clients would like us to have flown in person, and given it in person now, we're willing to embrace technology. So this change it bodes well for technology sector. I get a little wary of valuation, even though irrational exuberance will take some more time for technology to catch up in terms of facing the valuation tune. However, the other sector, actually, despite either precedent, I actually like, and it's one of our kind of outside theme that's out of consensus theme, is energy sector. If you look at energy sector over the last 5 years, it has gone from 10% of S&P weight to 2% of S&P weight, partly because COVID's hit oil prices and demand's dried out. Having said that, when you have a 80% drawdown, right, in prices and such a destruction, the winner actually, or what's left, will actually have a rebound over the next 2 years. So we're a little bit watching for a little bit of sign of demand pickup, because you're trying to catch a falling sword. However, we actually like energy sector as a theme, right? Those are integrated oil, not the frackers, right? I think frackers might have a longer difficulty, and you don't know who's going to be the winner that will actually make more money versus the loser that will go out of business. So we like energy theme over the next 2 years. And again, we have to watch the turning point and be a little more careful how we leg into it. But in terms of other winners, obviously
we are seeing shoots of that. So consolidation is happening in the energy sector right now, and we're seeing more and more news, headline news, or news of mergers making the headlines day in, day out.
Right. So we're going to stay quality, big is our theme, right? We don't want to go and try to pick winners and losers in any sector in the small companies. It's more challenging as a macro investor. We like to go with, for now, big is beautiful and quality is where you want to be until we get a little more clarity on the direction of COVID and, will we get a second wave? So that's more of a size and quality theme beyond any sector. As far as sector, the other sector that's done well, but will probably continue to do well under Biden administration is healthcare, right? Or actually under either administration, but perhaps more so under Biden, is healthcare. And there you also need to be selective in terms of what type of healthcare. Biden also will attempt to bring back Obamacare as a concept that may actually be negative to certain healthcare sub-industries that administer healthcare. That hasn't done well. So we have the playbook from Obama days to understand healthcare and how that will impact the industries. Net, we also think the other thing that as it's more COVID and recovery trade is value has tremendously underperformed, and rightly so, perhaps, right? Having said that, as growth is so well priced or moderately highly priced, value has been gone through some destruction, rightly so. We think over the next 2 years, this gap will narrow, and the right way to hedge a recovery and vaccine trade is to shift more and more of your allocation to value. Again, you have to monitor the vaccine recovery as you do that, but markets will have to normalize and value will catch up to growth. And growth may continue to run.
Now, Luba, maybe I could divert attention to you right now, because we did have this discussion earlier about valuations here in the region and how high they are. But on the lines that we were discussing on the energy sector with Jay recently, do you expect the same thing? Do you expect consolidation to happen here in the GCC, at least in the energy sector? Are we expecting privatization activity in the energy sector as well?
Well, firstly, I would like to agree with Jay's view. I think particularly from a excluding GCC perspective on the IOCs, definitely we're going to see some consolidation, and the large, well-positioned or well-capitalized players are most likely to survive. Cyclically, it seems as though low oil prices are perhaps setting us up for a period of low capital investment in that sector, which is essentially what propelled oil prices to the $100, $120 plus range, which was a direct result of the underinvestment that happened in the late 80s and early 90s. So the scenario is kind of in place for a similar outcome. Now, there are additional aspects that we need to consider, which is sort of the shift to green, which was nowhere to be seen back in the 90s. So it's not as clear cut, but I think definitely there's going to be consolidation. The industry is not going to look the same in 10 or 20 years time, and you're going to end up with probably significantly fewer players, and those who survive will potentially thrive. So overall, yes, I would agree with Jay on that one. From a regional perspective, the petchem and energy names have actually not followed the global trend. So we have Aramco here in the region, which had its IPO late last year, and it's currently still trading above that IPO price. So you have names that really haven't corrected over the last year despite record low earnings. So this is slightly distorting some of the valuations that we're seeing regionally. Obviously, there's we have the MSCI inclusion in Kuwait, and Saudi. I think a lot of the names got bid up as retail investors tried to play the oil price recovery when it briefly hit negative pricing. So this has really kind of distorted the markets regionally, and probably the energy sector within the region is not looking great, at least short term, until those valuations normalize.
And maybe back to you, Jane. In terms of back to you, Jay. In terms of the dollar, what are some of the forces that you see being applied from each candidate or party? So, do you believe directional forces? I mean.
Sure. So, as I mentioned, we're not a forecaster of currencies directly. However, as macro investors, you have to look at the forces at play. So, and here's where I'll also introduce gold. I remember you mentioned there's some interesting gold. We actually have, for the first time in our multi-asset portfolio, bought gold. We bought gold for a couple of reasons. One, even before the blue wave or full sweep by the Democrat, or that being a possibility, we bought gold possibly for concerns that we have debasing of currency with a fiscal around the world, where there is no one's talking the word currency war, but all this fiscal spend is actually debasing of the currency, or risk of debasing of currency. And here we have now US embarking on biggest fiscal, not only on in its own history, but also against other countries, catching up perhaps versus Japan and Europe in terms of its fiscal as percentage of GDP. As a result, both in terms of looking at a downside scenario or upside scenario, we like gold over US dollar. We think generally the pressure on the dollar is to weaken under Biden. Now, with that said, the thing that's not clear as a currency expert is it's already weakened sufficient amount. I think it should further weaken, but that's more looking longer term. I just don't know to what extent it's going to weaken much further, but the direction of the dollars to weaken against euro and other currencies, and for gold, I think to do very well in the next 12 to 18 months.
Okay, on volatility expected or on the back of uncertainty. So how do you see that play out? Again, we are looking for when I say what are the forces behind each candidate or each candidate's pressure on the dollar, either on the upside or the downside. Yeah. Who do you put your bet on will push the dollar higher and who will push it lower?
I would think if because my thesis is about the size of fiscal it will dictate the pressure on the dollar. Trump will under President Trump re-elected, we'll see a more modest fiscal and therefore there will be less pressure for dollar to weaken. And under if Biden becomes the President Biden, then we'll have with a sweep. That is, we'll have a much bigger fiscal if he gets a full sweep. Then there's a larger pressure for dollar to weaken, and therefore gold to do well. And by the way, gold is a hedge to obviously large fiscal and stimulative and inflation possibilities, risk possibilities. But also, gold is good for even if we have a very severe second wave, etc. It does protect also on the downside. If I just want to play reflation, if I'm so convinced that we're going to get a strong reflation, I wouldn't just buy gold. I would buy gold miners, which is gold stock, which has higher beta than gold, something like almost close to 2 to 1. Or I'd even buy silver. Under the right situation and recovery, I think I've read about silver possibly going back to the peak we saw in a couple times in the last 50 years, which would put it at $50. If that path comes to fruition, and if you're truly a believer of reflation is definitely coming, then silver becomes more interesting than gold.
Interesting.
If I may just ask out of curiosity, so if you're seeing or if the play is sort of the reflation kind of trade, what is the view on rates? Because obviously we have the view of kind of lower for longer,
sure.
and rates have been very low for quite a while, yet we haven't really seen significant pickup in inflation.
Right. So I think the first order question is the central banks around the world, with all the QE that they've done since great financial crisis, haven't been able to induce inflation due to technology and other so-called deflationary pressures, demographics, etc. Will they get it right this time, or will they, with all the massive fiscal on top of QE, be able to produce inflation? Left to be seen.
Yeah.
But what market's pricing in is through 2024, likely the Fed's going to stay put. We may not get the sufficient amount of inflation, and we're not talking technical inflation that we may get of 2 and 2.25, 2.5 for a brief period, just because inflation also might draw V or CPI. We're talking about sustainable inflation where the Fed's going to take action. What's interesting is with blue wave, and these are just market forces, market has actually now priced in Fed raising rates, investors have been buying up options that Fed fund might actually start to get hiked up in 2023. Apparently, quite a bit of money on options market have played that trade last week. So I read that on Bloomberg, so you can go read it. So more and more investors are expecting possibility of Fed needing to fight inflation by raising rates as early as late 2023. I don't know. It's so far out. I think Fed has promised to stay lower for longer, and for now, I will stick to 2024 at the earliest.
What is the threshold? So they said a sustained inflationary figure of above 2%.
Yeah.
So what is the threshold? What do we have to see before we start to expect interest rate increases?
So I'm going to say, Robert, jump in if I get it technically incorrect, because he has a better memory than I am due to younger age, and he's just a smarter kid. And sorry, I called him a kid, but relative to, he's about half my age, so I can get away with that. So Fed had a goal or target of 2% on inflation, and they recognize that we've been over a decade below that number, or well below that number. So they didn't want to give market fear of, if we get past 2%, that they're going to do something. So they said on average over, I think it's like 3-year average or some average over multiple years, if that number goes above 2, and even there they'll tolerate some inflation on average going over 2. I think you have some, famous investors, I won't mention all their names, that are actually calling for the amount of fiscal that might come into play. Once inflation gets stroked, it's hard to stop it. We saw that in the 70s, right? In the 70s, partly with OPEC and oil prices, we actually had a runaway inflation, and Volcker took for longest time and took some extreme policies to contain it. So one fear that market participants have is if Fed will let it run too long, that it will actually then lose control. But at this point in time, I think near term, if inflation or CPI reads above 3%, but unemployment remains still elevated, because wage inflation, which is the payment to workers, is that true inflation that Fed doesn't want to get out of control. Some of the temporal inflation due to commodities basket is not something that they're going to pay too much attention to. So that source of inflation is going to be very important. Robert, do you want to add anything? I know you got a very good technical read on some of this stuff.
Thank you, Jay. You hit the nail on the head. Jay made a lot of great points there. First of all, for investors, it depends what type of inflation we're seeing. If it's the type of inflation that's going to cause the Fed to raise rates, that will have big implications for fixed income and equities. So that's what we have to watch. Jay mentioned what that type of inflation is, and that's wage inflation. And let me explain why. The Federal Reserve not the Federal Reserve. You've probably all seen a large push for equality. Equality is like the #1 topic now, especially in the United States, but around the world. Protests in Nigeria against police brutality. You have, and then in the US, you have the Black Lives Matter movement, and you have people being more cognizant of unequal pay. The Federal Reserve also recognizes that. They have a dual mandate: full employment and inflation. The change, they will never explicitly say this, but the change to their inflation targeting policy is inexplicitly a change towards focusing on equality. So they will try to go for full employment now, rather than just targeting prices. And they want to go for that so that we see wage inflation get stoked. And so if you do see wage inflation, I think that that's a good sign for investors that interest rates may move higher. But we do believe that interest rates are lower for longer. So if you see commodity inflation or maybe some inflation because of deglobalization, that will actually just push real yields lower. And that'll be great for investors. Because if real yields move lower, that means that stocks are even more attractive. And that means that yield generating assets like real estate and municipal bonds and private debt markets and private equity markets are even more attractive.
That's a great.
Listen, to the audience, I'm reading questions as I receive them, so I'm blending them into the discussion because I don't want to be left with. We really want to get all the topics in. Now, on the final topic and the final question, we have to save the best for last. On trade wars and the rise of protectionism, what do you believe will unfold, and how will it impact the global trade balance? So is it going to be on a Biden apology campaign after what Trump did during this administration, or
Yeah.
how does that work out?
Jay, I'll set you up just with some background. Biden's a foreign policy expert. He will look to rebuild the foreign policy of the United States, put people back in place who should be there, and he will look to strengthen ties with allies. Tough on China will be the policy stance of whoever's in office. It's just how they do it.
That's a great point. I had nothing to add. I think Robert hit the nail on the head. Trump's made certain enemies of our allies. I think Biden's going to heal that relationship, and there may be some apologies given. However, the stance on China and future of world dominance is going to be on so-called conceptual 5G or technology. And I do think Biden's going to be perhaps equally determined, given it's a bipartisan, both parties, Democrats and Republicans, commonly have against China, as well as I think Europe's actually even embraced a tougher stance on China post-COVID. So I think China policy may stand, and deglobalization trend may not go as fast under Biden, but will continue.
Okay, gentlemen, I think we've consumed our time for this evening. So probably in closing remarks, I would like to thank everyone who attended, and more importantly, our guest speakers for making themselves available for this interesting discussion. We do have to contemplate what is ahead of us in order to take the necessary actions. When there's a challenge, almost always there's an opportunity, whether it's an opportunity to preserve gains or an opportunity to create more. Risk on or risk off, and how to diversify it. This is how we aim to guide our clients through the multitude of challenges ahead. Gentlemen, thank you so much for your time, and thank you so much for your insight.
Thank you very much for inviting us.